A big part of what investors do is to react to information they receive. And now more than ever, an investor has access to a bunch of qualitative and quantitative information on markets and individual securities. In some cases, this information is provided by news organizations via the web, such as the information you can get throughout the day on movements in market indices and individual securities like on Yahoo Finance or Google Finance. Information is also available through brokers, either personally or via news feeds provided on online trade platforms. These sources provide you with information on lots of different things, such as what the Fed chairman said or didn't say, if a CEO was fired or not, if a freeze in Florida will affect the orange juice yield. In addition to this kind of information, there are now many sources of either platforms that allow you to conduct your own analysis or provide you with the results of such analysis. This type of information is usually in the form of some sort of special measure or summary statistic based upon past data. In this course, we'll look at some of these metrics. This course will be especially helpful to you as a consumer of this kind of information, since many of the measures these platforms provide are the result of fairly complex calculations, and unless you know the details of how these measures are calculated or what they are supposed to tell you, they can be very hard to interpret. In this course, we'll examine the justification and interpretation of these measures. While it is clearly useful to know what these measures are and what they're supposed to tell you, not only do you need to worry about what they are, you also need to worry about how you react to these measures. The bottom line is that although you are a thinking machine, you're a human thinking machine, and there is mounting evidence that on average, humans make a number of systematic cognitive mistakes when processing information. In this lecture, we're going to look at some of these cognitive biases to see how that might impair a person's investment performance. We will look at these cognitive mistakes for two main reasons. First, while it may be true that you personally do not make such cognitive mistakes, I know that that can't be true for the majority of people. And one of the most common cognitive mistakes people make is in assessing their own susceptibility for making systematic cognitive mistakes. So even if you don't think these mistakes apply to you, since the majority of us think that and make systematic mistakes, many of us are just kidding ourselves. Rather than rely on our potentially mistaken perception of our own ability, I want to use this discussion of cognitive errors as a way to motivate the need for methodical, non-emotional methods for evaluating your reactions to information. Moreover, since many professionals are subjected to cognitive biases too, these methods are equally important for you to know if you opt to delegate the management of your investments to a professional. A second reason to examine the types of cognitive errors humans make is to potentially profit from any systematic pricing errors that such biases might create. Okay, so let's look at some of these behavioral biases. I'm going to tell you about three in particular. One is called framing, two, biased self-attribution, and three is seeing patterns when none exist. Let's look at framing. That people can suffer from a framing bias is something that psychologists have been documenting many times in experiments, and I've actually been able to replicate in my university classroom. For the experiment, I split the class into two parts of about 50 to 60 students each, so that you're convinced that the phenomenon I'm about to talk about has nothing to do with differences in intelligence, but rather is a common cognitive mistake that even smart people make. I'm careful to split the groups so that there's no selection bias in the groupings. So I don't split the groups according to their physical location in the classroom. Undergraduate students are fairly cliquish, with a high likelihood that one half will have more cliques of smarter people than the other half. I also don't split by alphabetical order of their last name, since that may disproportionately group one set of people by country of origin, which might be correlated with cultural effects that might systematically affect how they answer the questions. Since student numbers are random, I split them by the last digit in their student number. So that they don't feel subordinated, I say that odds are in group 1 and evens are in group A. I tell group 1 to find something on the internet, for example, Albert Einstein's birthstone. And while group 1 is doing that, I tell group A that they are in charge of public health in the United States, and there's going to be an outbreak of a new infectious disease that is expected to kill 600 people if nothing is done. They have a choice. Under program L, 200 people will be saved. Under program M, there's a 1/3 chance that all 600 will be saved, but there's a 2/3 chance that no one will be saved. Then I ask each person in group A to pick the program they prefer. I then get the attention of group 1 and tell group A to find how many times the Nobel Prize in economics was awarded to somebody in England. While group A is distracted, I tell group 1 that they are in charge of public health in the United States and that there's going to be an outbreak of a new infectious disease that's expected to kill 600 people if nothing is done. They have a choice. Under program X, 400 people will die. Whereas under program Z, there's a 1/3 chance that no one will die and a 2/3 chance that all 600 will die. I have a couple comments on this before I reveal the results. First, notice that I really asked the two groups the same question. For group A, I framed the question in terms of saving people, while for group 1, I framed the question in terms of their decision killing people. In both first choices, there are 200 people alive and 400 people dead. With group A, they saved 200 people, which is equivalent to having 600 minus 200 equals 400 dead. With group 1, however, the decision results in 400 people dead, which of course is equivalent to having 600 minus 400 equals 200 alive. That is, the first choice for each group is exactly the same. For both groups, the second choices are also equivalent. But the one for the group A is again framed in terms of saving lives, while for group 1, it's framed in terms of killing people. For both second choices, there's a 1/3 chance of having 600 alive and no one dead, and a 2/3 chance at having no one saved or all dead. Second, while there is a clear choice between the two different options, there's no right or wrong answer. It depends upon how risk-averse you are, and that's something that is completely personal. The first choice presented to both groups can be characterized as a sure thing, 200 alive and 400 dead for sure. The second choice offered to each group is risky, a 1/3 chance at 600 alive, 0 dead, or a 2/3 chance at 0 alive, 600 dead. For an expected number of alive of 1/3 times 600 equals 200, or an expected number of dead of 2/3 times 600 equals 400. The expected number alive and dead is the same in both choices, but some people may strictly prefer to have a chance at having everyone alive. Thus, they will like the second options better. Other people may strictly prefer to avoid the chance of having everyone dead. Thus, they will prefer the first option. Thus, if there is no systematic differences in the composition of the two groups, say due to cultural differences or differences in intelligence, then the fraction that prefers the first to the second option should be basically the same across the two groups. That is, unless the way the decision was framed affects people's perception of the problem systematically. Only the framing is different. In fact, when this experiment is conducted, the typical responses are very consistent with the fraction that prefers the sure option over the random option when the question is framed in terms of saving lives is 3-to-1, 75% sure to 25% random. But when the options are framed in terms of killing people, preferences completely flip, with 3 out of the 4 preferring the random option over the sure option. 25% sure to 75% random. Furthermore, these ratios are fairly consistent across all times people have conducted this experiment, including when I've done it in the classroom. Thus, it seems to me that it clearly has something to do with the framing and not the fundamental differences across the groups. What this implies is kind of disturbing. First, it implies that our choices can be manipulated by framing. I think marketing people know that. But second, the systematic differences in responses also implies that, completely independent of the cold, hard facts of statistics, context may drive our decisions. Another example of this is a phenomenon that investors tend to sell winners and hold on to losers, even when there is no relationship between the future returns and past returns. Even if, regardless of whether the stock just went up or just went down, there's a 50-50 chance of winning or losing over the next period, most people would prefer to sell the past winner and hold on to the past loser. Having an asymmetry based on past performance is just like a framing bias with the disease. Although the past has nothing to do with the future opportunities, people typically make systematically different decisions depending upon the past return. Similarly, although the possible outcomes have nothing to do with whether the outcomes are expressed in terms of saving lives or death, people systematically make different decisions depending upon the framing. By the way, one possible explanation for why investors sell winners faster than losers is because deep down, they do not want to admit failure. By selling a stock that just went down, they are realizing a loss, which prevents them from being able to claim, if only in their own heads, that it was really a good investment. But if they sell a winner, they get to claim that they're good investors before it has a chance to go down and prove them wrong. But to the extent that the actions are driven by something non-monetary, i.e. their pride, such asymmetries may reduce their investment performance. If there is no relationship between past returns and future returns, then such an asymmetry will not be costly. But what happens if there is what we call momentum in returns? In that case, the asymmetry locks in a substantial loss and forecloses on a substantial gain. Okay, the second thing that we want to talk about is biased self-attribution. This is another thing that people tend to do on average. So biased self-attribution is when a person doesn't assign blame or credit fairly. Consider a person, let's call her Jane, who while watching CNN heard a report on a biotech firm that is creating what the report said was a series of compounds that might increase the effectiveness of certain treatments for diabetes. During the report, the CEO was asked if the compounds were sufficiently unique that they could be protected via patent. Jane thought that the CEO not only seemed to be a nice guy who genuinely cared about diabetics having more effective treatments, but also he was a very smart guy who, even though he may have had the incentive to exaggerate the potential for the firm's products, seemed to have a lot of integrity. On the basis of that report, Jane bought 200 shares of the company at $15 per share. The next day, Jane was watching CNN again and saw a report on a cybersecurity firm that had developed a firewall based on an innovative structure designed to protect information passed by mobile devices. This firm had many clients in financial services and in medical record processing. She could also tell, just by listening to the CEO speak about the varied applications of this new design that could be uniquely served by this product, that he too was a smart guy with integrity and a passion for his product, all traits of someone destined for success. So, of course, she bought 100 shares of that firm, which were selling for $50 per share. A month later, she saw that the cybersecurity firm had risen from $50 to $56, a 12% return in just over a month. At that rate, her initial investment of $5,000 would grow almost 4 times that after a year. She knew that it was unreasonable to expect that she would get 12% every month, but still, she felt pretty good. That night, over a nice bottle of wine, she bragged to her husband that she knew that CEO had something on the ball. She was not only a good investor, but she was also a good judge of character. Of course, the next day, news came out that one of the biotech products of the biotech firm thought had such promise failed to pass some of the FDA's drug tests that had to be passed before they could turn the drug into something that could be widely distributed. In response, the CEO issued a press release stating that the compound had passed their own extremely rigorous testing process and that he believed they would ultimately be successful after they appealed the results. The market was not convinced, and the stock price fell from the level she paid of $15 all the way down to $9 for a $1,200 loss, or 40% in just a month. That night, over a stiff shot of scotch, she complained to her husband that she could have done well on that investment if it weren't for the FDA. Not only did she feel that the firm was wronged, but she also felt that she was wronged, having lost 40% of her investment based on what appeared to be an unreliable test. In addition to a potential drinking problem, Jane suffers from biased self-attribution, which is when a person gives themselves credit for what turned out to be a good decision, but places blame elsewhere when a decision they made turns out poorly. In Jane's case, she took credit for seeing something in the cybersecurity CEO, but blamed the FDA for the loss on the biotech firm. How many times have you done this? Although not within investing, I think I do this fairly often. For example, every Thanksgiving, I roast a turkey. To be honest, I think it's hard to roast turkey well, to consistently keep it moist, but make sure it's cooked enough that salmonella is not an issue. I don't know how many times I have said, after presenting an overcooked, dry bird, we must have gotten an old bird. But when it turns out really nice and juicy, I say, boy, do I know how to cook or what? While biased self-attribution may be just a bit annoying at the Thanksgiving dinner table, it can be really costly in terms of your ability to accumulate wealth. Why? Because if you believe what Jane believes, you will teach yourself to be overconfident. If every time something good happens, it's because of your skill, but every time something bad happens, it's not because of your skill, then you will get a false sense of ability. In Jane's case, she will get the sense that she can judge a good investment just by seeing the CEO speak. If she has this sense, then she may neglect doing the kinds of analysis that will actually identify opportunities and risks. Okay, let's consider another behavioral bias. Here's something else that people do that's kind of related. Consider a plot of a stock price over the course of a day. If you look at it, do you see any patterns? Any patterns in the price level or any patterns in the price changes? Or are they just completely random? I often ask my students this, and most see patterns. Experimental psychologists have documented this too. They find that most people tend to believe there's a pattern in a random sequence. That is, they see a pattern where there really is none. This is problematic when it comes to investing because patterns typically imply trade opportunities. If you knew there was a stock in which every time it went up, the next day it had a 60% chance of going up again, and if every time it went down, there was a 60% chance it would go down the next day, then you could make a lot of money buying after up days and selling after down days. To see this, consider the following simple example. Let's say yesterday at the close of the market, the price of Sleezco was $10 per share. By the way, don't ask what Sleezco makes. Today, there's a 50-50 chance that it's going to go up or go down. If it goes up to $11, and if it goes down, it will fall to $9. If it goes up to $11 today, let the probability that it will go up another dollar to 12 be P, and the probability it will fall to 10 be 1 minus P. That is, P is the probability that it will continue or change in the same direction. 1 minus P is the probability that it will reverse. Similarly, if the price goes down to $9 today, then let the probability that it will continue to fall another to $8 be P, while the probability that it will reverse by a dollar and rise to $10 be 1 minus P. If P equals 0.5, 50%, and thus 1 minus P also equals 50%, then knowing whether the price went up or down today doesn't help you predict where it will go at the close of the market tomorrow. But if P is greater than 0.5, then if it goes up today, it's more likely than not that it'll go up again. And if it goes down today, it's more likely than not it'll go down again. That is, there's a pattern. It's not for sure, but it's probabilistically a pattern. So if it goes up today, you should buy. And if it goes down, you should short. Recall that shorting is when you sell something that you don't own. Rather, you borrow it, sell it, buy it back in the future, and return it. If the price you sell it for is larger than the price you have to pay when you buy it back, then you will make money. But if the price rises, you'll have to buy it back for more than you sold it for. In that case, you are out some money. You've experienced a loss. So if you think there's a pattern and you buy after the price rises and sell short after it falls, what is your expected gain? Well, let's see what happens if the price goes up. If the price goes up today, you'll buy, say, 1,000 shares. That is, you'll pay $11 times 1,000. You're going to spend $11,000 to get 1,000 shares. Then you will be able to sell those shares the day after today for either $12 per share, P% of the time, or at $10, 1 minus P% of the time. For an average price at the close tomorrow of P times 12 plus 1 minus P times 10, which by the way is equivalent to just 10 plus P times 2. Thus on average, you will get 10 plus P times 2, all of that multiplied by 1,000 for shares, which equals 10,000 plus 2,000 times P. If P is greater than 50%, 0.5, then you will sell for more than $11,000, which is an expected gain. Similarly, if the price goes down to 9, then you will sell short 1,000 shares and get what? $9 times 1,000, $9,000. After a day, at the close tomorrow, you will buy the shares back to close out your short position. And you will pay what? P times 8 plus 1 minus P times 10, which by the way equals 10 minus $2 times P per share. If P is greater than 0.5, then you again will make a gain. You short sell at $9 per share and buy them back for less than 9 per share. In fact, a little algebraic manipulation shows that your expected gain is actually going to be, what, $2 times P minus $1. Thus, if P is 0.6 or 60%, your expected gain is going to be 20 cents per share. If P is 0.8, your expected gain is 60 cents per share for 1 day gain. For 1 day gain, that's going to be 0.6 times 1,000 shares. That's $600. If P is equal to 1, then the expected gain is $1 per share for 1 day. A gain of $1,000. If you could do that every trading day, that's $252,000 a year. By the way, there's 252 trading days per year. Not bad. So you can see why people look for patterns, even patterns they're not even sure about. But what if you see a pattern and none really exists? If we make this a little bit more realistic, then let's say that regardless of whether you're buying or selling, there's a transaction cost of 20 cents per share. As we'll discuss later, bid-ask spreads, the difference between the price you have to pay and what you have to sell it for at any given moment, they create this kind of transaction cost. Now, if there is no pattern and P equals 0.5, then transaction costs will eat you up, and other traders will make a living trading with you. And it's worth if you're paying an online broker something like $5 to $10 per trade. In fact, a little bit more algebra shows that if the price change in any given day is delta and the transaction cost is T, then the probability of continuation is P, then your 1 day expected profit per share is 2 times P minus 1, all of that multiplied by delta, the whole thing minus 2T. So for example, if P is less than 0.5, then you will lose money for any positive transaction cost. But even if P is greater than 0.5, you can also lose money if the transaction costs are big enough. For example, if the transaction cost is 20 cents and the delta is $1, then you will lose money for any P less than 0.7. So the bottom line is, if you react to non-existent patterns, that can be really costly to you. And even if a slight pattern exists, you can lose a significant amount of money in the short run if you trade too frequently. By the way, a really good question is, why do we see patterns when none exist? Well, so one explanation is it's a throwback to when we lived in more primitive times, when saber-toothed tigers roamed the earth. If back then we believed that every time the grass rustled, we were more likely than not to get attacked by a saber-toothed tiger, then whenever we heard the grass rustle, we would run for our lives. Of course, we probably did a lot of unnecessary running, especially on windy days. But that's okay. There are two types of errors that we can make. In statistics, these are labeled type 1 and type 2 errors. Type 1 error is rejecting a hypothesis that's true. Type 2 error is accepting, actually failing to reject, a hypothesis that is false. If a person is presumed innocent until proven guilty, then we would say a court commits type 1 error when they convict an innocent person. But the court commits a type 2 error if they let a guilty person go free. In this example, it may not be clear which type of error is worse from a societal perspective. But for the saber-toothed tiger case, the maintained hypothesis is that rustling grass is a tiger. Thus, type 1 error is not running when a tiger is there, while type 2 error is running when there is no tiger there. Clearly, there's a big difference in the cost of these two errors. The cost of type 1 error is being eaten by a tiger, while the cost of type 2 error is maybe getting out of breath and maybe having sore legs. So humans may have a bias to believe something is there even when it is not there. Another example of this comes from the chickens of behavioral psychologist B.F. Skinner. Skinner would put chickens in a cage that had a device that would randomly eject a food pellet. Next to the pellet tube was a little red circle that had nothing to do with the dispensing of the pellet. Many of the chickens would peck the red circle. In some cases, a pellet would fall purely by chance. After a while, whenever the chicken wanted a pellet, however, it would peck at the red circle, thinking that pecking produced a pellet. In fact, since the pellet arrived randomly, they didn't have to wait long. But the point that they interpreted the pecking and the arrival as causal, as a pattern, is what's consistent with what we do as humans. In fact, some chickens might have turned around prior to pecking the red circle and by pure chance received a pellet. These chickens then started to believe that it wasn't just the pecking that produced the results, but also the turning around in the pecking. In fact, some chickens developed sort of elaborate dances to produce pellets. But the arrival of the pellet was purely random. The chickens saw a pattern when none existed. Perhaps this is why athletes don't shave when they're playing the playoffs, or they don't change their socks. I think just like Skinner's chickens, that they think there's a pattern when none actually exists. You may do this yourself when you're looking for patterns in returns or prices. In fact, it's fairly easy to do this since the types of patterns we think we see are often very hard to sort of quantify. Chartists are people that do technical analysis. These are people that look for and trade on patterns. If you ask a chartist to describe the pattern, they typically explain that it's not a set pattern so much as a sense of a pattern, that no two head and shoulders patterns look exactly the same. But they're very similar in shape, sometimes recurring within a day, sometimes over a week, sometimes with high shoulders, other times with lower shoulders. In other words, it's like interpreting the shapes in clouds or interpreting the dances of chickens that produce pellets. If it were easy to quantify, then we could do that and then reject some patterns. But because it's hard to quantify, it's harder to systematically reject it and therefore easier to believe in. So I want you to be very careful about this. Throughout this lecture, we've seen how investors can make costly cognitive errors in reacting to information. In subsequent lectures, we'll examine some concrete techniques that will allow you to evaluate how you react to things that generate performance. That way, you don't have to rely on your feelings, which we have seen can be unreliable and subject to cognitive errors. We will also discuss how such cognitive errors may generate trade opportunities. Of course, you'll want to use the performance evaluation tools we develop later to evaluate whether or not these potential trade opportunities are there or not, whether there's a saber-toothed tiger there or whether it's just the rustling in the wind.